Hello everyone and welcome to the Q3 edition of our Reinsurance Power Panel, and indeed join us on an odyssey around the July 1st renewals and more. To do that, we welcome a super lineup made up, first of all, of a newcomer, Peter Wilkie, Specialty Lead at BMS Group UK. And alongside Peter, some familiar faces: Paddy Boosfield, Managing Director of Howden Re Bermuda; Ian Reynolds, Director of Third Party Capital at Peak Re Hong Kong; and Ming Lee, Partner EVP, Global Head of CAT at Acrisure Re. So welcome, gents, and to get us rolling, how did the record high reinsurance capital and the booming ILS cat bond issuance shape pricing, attachment points, and structural flexibility during the July 1st renewals? Ian, I'll start with you.
Yeah, that's cool. I think, well, if we sort of recap the stories of 1st of January and 1st of April and other renewals throughout the year, it's all been about excess supply. That story continues. The stories in prior quarters was more one of discipline around structures, but perhaps rate softening. I think we're starting to see a little bit of slippage on the discipline around structures. With regard to the ILS capital, certainly we're not seeing, there's one or two exceptions, but we're not seeing much impact internationally. It's mostly driving what's going on in the US. There are some pretty surprising things getting placed in that market, and I think it's definitely fair to say that we see a lot more appetite for aggregate structures in the collateralized space than we are seeing in the rated space.
Just dig a little deeper onto that point around ILS if we can. Paddy, are we seeing ILS really push on those rated carriers?
Yeah, absolutely. I think you're seeing, exactly to Ian's point, ILS more comfortable in US and kind of global roles, which is pushing rated carriers into an international. But the excess supply is definitely making it potentially softer in certain areas. I do think ILS has also been focusing more on innovating in casualty and specialty lines. So we're seeing special purpose vehicles supporting those rated carriers. So it is a little bit of a, if you can't beat them, join them approach for these rated vehicles. They're taking ILS, but on the retro side. So, but it continues to come into the market, and there's excess capital in various forms, both rated and non-rated.
Well, Paddy touched there on this idea of excess supply. Peter, what are we seeing around the excess capacity?
Yeah, as Paddy mentioned, we're seeing that additional capacity come in on the UNL side as well, so from the traditional reinsurers, which creates this double effect really, because I think as well as the dynamic that Ian and Paddy have talked about with the aggregate covers coming in more on the cat bond side, we're actually seeing lower attachments as well from that, which is then pressing the top of the programs, the UNL programs, and they end up competing maybe more with the UNL underwriters. At the same time, there's a lot more capital going into that traditional UNL space as well. So we've got that sort of double effect by the pressure from new carriers, or new capital at least, alongside the extra pressure from softening terms and conditions and potentially lower attachments on the ILS side.
And are we seeing the supply of capital, Ming, surpassing demand at the moment?
Yeah, absolutely. I think it's pretty evident there's abundance of a supply of capital, and it's much higher than the demand at this point, which kind of evidence from the many oversubscribed programs that have been placed in the market. But I just to echo what I said earlier, it is, the price had been decreased compared to last year, and especially so for the mid to the high layers because of competition from ILS, competition from the cat bonds. And in terms of structural flexibility, I think reinsurers, they still prefer the layers covering a large occurrence rather than frequently the small events, but that's definitely going to be increasing discussion about some aggregate layers, the prepaid reinsurance and the second event covers, etc. It's not going back to like a few years ago, but it's still, the kind of conversation has to come back to the table, which is leading some healthy conversation between the carriers and reinsurers.
Let's keep digging then on the July 1st renewals. Paddy, what level of rate online reductions did reinsurers grant on the property catastrophe treaties? And indeed, how did loss-free versus loss-hit programs differ on July 1st?
Yeah, thanks, Bo. And I think you've hit on the major kind of divergence. When there was loss-affected treaties, either the structure was amended to ensure the expected loss cost was similar, if not less, to reinsurers. So you saw kind of flat to slightly up. And then on risk-free, that's where we did see some price competitiveness. Again, the common theme to this conversation will be oversupply. And there was definitely some oversupply there. And I think most interestingly, going back to the ILS angle, we've been seeing ILS get in through rated fronted vehicles into spaces they weren't before. So there's an easier way for them to increase that supply. So on loss affected layers, it was definitely muted, if not slightly up, but on loss free, it was down substantially.
And did you also see that differentiation between the two types of business?
Yes, definitely. That was a really important dynamic, I think, that we saw as a real increased differentiation. So we've got some pretty good reductions, on the business that is loss free. There's a lot more analysis going into the loss affected business. Reinsure, as much as there might be this extra capacity and there is a willingness to be flexible, that doesn't necessarily stretch to covering far more cedants losses than they have been for the last couple of years, and sort of moving back to a position where they feel they're really sitting in the money. And I think that when we looked at the more loss affected business, we really saw that there's not quite that same flexibility yet. Of course, with the extra capacity, that might change. But for now, there's a clear differentiation. We're getting pretty sizable rate reductions as well as terms and condition improvements on loss affected business, on non-loss affected business, but not on the loss affected side.
I saw an interesting contrast there. And Ming, are we seeing any consistency in the markets at all?
Yeah, I think observations have been very consistent with what Pete and Patty just mentioned. For the loss free program, we have seen double-digit decrease in terms of risk-adjusted rate online. But if it's a loss-affected program, it is either flat or sort of slight increase in the rate onlines. And I think the reinsurers are taking a very differentiated and a disciplined approach when it comes to underwriting business. So the experience matters, especially for the programs recently affected by like U.S. severe convective storms, also wildfires. And the reinsurers want to examine the loss, the claims data, and understand how the carriers have been handling those events. So it is, as mentioned by Peter and Patty, it is a very differentiated approach taking in the market.
And Ian, what does this mean internationally?
Yeah, I think, for internationally, there's not a lot of business at 1st of July and not much loss activity. So that differentiation is not there, but the international business is not immune from the softening. We have seen that level of softening internationally.
Okay, well, let's zoom in on brokers' business. Peter, did brokers secure broader terms and structural improvements on July 1st, particularly, of course, for those property and specialty lines?
Yes, definitely. It was a buyer's market. I think that we could secure good rate reductions on property and specialty. Again, caveating that with it being loss-free or at least well-performing. And I think in terms of terms and conditions, we saw a broadening as well. So that might be in terms of products covered, in terms of peril, in terms of jurisdiction. So we saw the softening there. I think in terms of attachment, we're not seeing that quite so much yet. That seems to be seen as a last resort by reinsurers. So the desire to go back to where we have been in the past is not quite there yet. So I'd say at the moment we're more seeing price reductions, terms of condition reductions without wholesale changes to attachment points.
Okay, and Paddy, are carriers pushing terms here?
Yeah, absolutely. I think, most of the carriers buying have reinsurance arms, so they understand the dynamics that's happening on the other side of the balance sheet or other side of the fence. And they've been pushing brokers to kind of push terms out, but they've also, we look at broad specialty lines, there's been a fair amount of losses and displacement. So it hasn't been a slash and burn on terms and conditions, but it definitely has been, kind of a sensible, disciplined broadening. And the great thing about our market is if people did push too hard, we'd read about it in the press. So it's been relatively disciplined, but broadening.
How does this period as well, Ming, compare to previous programs?
Yeah, I think overall the terms and conditions have greatly improved across the market for many programs if you compare to a couple of years ago, the hard market. And also there's the increasing flexibility with the coverage. if you remember from a couple of years ago, those aggregate covers or multi-year covers is basically off the table. For now, the conversation about those frequency event coverage is coming back to the discussion, leading to, because there's clearly demand from the carriers to bring down the cover and to the lower return periods. So that is an increasing conversation about those aggregate and multi-year covers, and also the subsequent event covers between the players.
So improved terms then, Ian, does that also mean more appetite?
I think what we've definitely seen is some buyers expressing their appetite for aggregate cover and instructing their brokers to, while there's been discipline on the event cover, trying to instruct their brokers to tie a line on their aggregate program to the event cover, and that's where we've seen a little slippage in the market.
Well, we do, of course, know that this has been a strong period for reinsurers, showcasing some impressive return on equity post 2024, mid-teen returns, often noting a stable Q2 as well. But are they signaling any tightening ahead, perhaps via restrictiveness on high-risk jurisdictions, or indeed scaling back on less profitable lines? What are you seeing, Ming?
Yeah, I mean, the reinsurers have been doing great over the last few years. I mean, we expect to continue to be a stable market. And so we don't see any tightening signals across the market on the broad basis. But, the challenges still exist, like the inflation, economic volatility, the climate change, and also social inflation and regulatory environment. So reinsurers continue to take a very disciplined underwriting approach, which means for some of the high-risk areas, like Florida. I mean, Florida has been doing much better compared to a couple of years ago because of the legal reforms, but still, reinsurers have been quite cautious when it comes to deploying capital in Florida. And another high-risk area is California, with the recent wildfire events in Los Angeles early this year. So the reinsurers have been quite cautious over there too. But otherwise, we don't really see any broad tightening signals across the market.
Okay, so Ming says caution, but perhaps not any major scaling back. Is that something that you would agree with, Ian?
Yeah, I mean, it's hard to say going forward, but certainly at 1st of July and prior to that, we've seen plenty of carriers with a growth mandate, so there's no obvious aversion to high-risk business.
And Paddy, from your perspective, what are you seeing across the different lines and areas here?
Yeah, I broadly agree there's not been an aggregate scaling back, and mainly because anybody who has tried to scale back, somebody else has come back in, or a new entrant has come back in to absorb that. But I think when we look at casualty, and obviously there's been some pretty big headlines around litigation financing in the US and that system, there is pockets of casualty that people are slightly aware of, given the adverse development. But while we've seen certain carriers come back, there's been new carriers to step into their place. So as a macro market, scaling back has not been indicated, but for certain reinsurers, there has been scaling back or realignment. And I think, as Ming mentioned, with the continued loss environment around non-peak perils, people are just mindful of where they're deploying capital and deploying aggregate.
So it seems like the consensus is that there's not been a major scaling back across the board. Peter, is that something that you would agree with?
Yeah, I'd agree. There's only been scaling backs in very specific areas. And exactly as Paddy said, even if there are reasons, and there are plenty of reasons for reinsurers to want to be cautious in certain areas because of everything that's going on in the world, it's hard to implement because you will have this growth mandate from your management almost certainly, and you'll almost certainly have a queue behind you of carriers who are willing to take your place if you're too strict with any tightening. So yes, it's very hard for reinsurers to implement too much other than specific areas that have real problems.
All right, well, I'm just going to throw one final question at you all about these July 1st renewals, which is how did casualty and specialty treaty renewals behave relative to property during this period? And indeed, did cyber and other specialty lines continue to favour buyers, or was there a divergence in capacity and pricing? Ian, let's get your assessment first.
Yeah, I'll start with the cyber point. I think when we met last quarter, we were talking about some emerging cyber claims, and that has continued. Some quite high profile claims in the retail sector. That doesn't appear to have had any dampening impact on rate reductions. So we see that continually in cyber. Casualty, I think it's largely viewed as flat, but that's a market trend, and there's a lot of diversification. There's a lot of diversity within the casualty class, so it's not always instructive to take an across the board market view. So there are pockets of differentiation in casualty.
Okay, pockets of differentiation in casualty, says Ian. Paddy, is that what you're seeing as well?
Yeah, building off the cyber comment, I think, and we can talk about it in marine aviation more in several different lines of business. There seems to be a disconnect from the retail carrier to reinsurer around losses and how those feed through into wider market dynamics. Within cyber, it does seem to be significantly softer than it was 2-3 years ago. Might even be getting close to the softest portion of it. Within casualty, if we look at excess casualty, that's been a relatively growth market. And again, for previous comments, the carriers haven't been pushing too far, but they've been pushing some of the terms. I think on professional lines, we're seeing that as probably a hardening market, because the reinsurers are just seeing, they're not seeing the underlying loss activity and terms and conditions meeting up with what they think the expected burn is.
Okay, it's only fitting that on his debut, Peter, we offer you the final word on this.
Yeah, I think, as Ian and Paddy have just said, I think that casualty is an area that's slightly different dynamics. It's obviously got that inbuilt diversity and not being driven the same way that specialty and property are. So I think the specialty is much more like the property area in terms of the new entrants, in terms of the new capacity coming on board. And actually, that has meant that you've got this softening at a time where you might not expect it if you look at everything that's going on in the world. So, for example, these marine and energy composite programs have still got to settle Baltimore Bridge. They've still got to settle aviation war leasing losses in Russia, potentially war and man losses in Ukraine, potentially wildfire losses in the fine art book. So based on what we're seeing in the world, we might expect reductions, but because of the excess capacity that's there, actually this has not happened so far, and we don't expect that it will do in the near future. We still expect it to be a good market for buyers for the foreseeable future.
Great, Fortuna, a very timely conversation indeed. Huge thanks to you all for your time today. And remember, of course, that we will be back in the final quarter of the year. But until then, keep it right here at Reinsurance Business TV.